From the morning reading, it looks like the U.S. stock market is rejoining the global stock rally. The New York Stock Exchange Composite Index traded at a new all-time high. The NASDAQ is doing the same. The SPX is close to a new record as well. The S&P 500 rising above its symmetrical triangle resistance line. A close above its February high of 2119, which appears likely, would put it in record territory as well. With respect to the NASDAQ, the latest rise follows several stalled attempts to surpass the index's high water mark in recent months. The NASDAQ finally matched the S&P's feat of closing at a record high. This is the first time since 1999 that both managed to do so on the same day. When it has happened in the past in April, the summer months have tended to be flat at best. And finally, if you look at money flow and the SPY, traders should consider showing restraint, entering new long positions. The event will trigger a sort of brain chemicals in traders that will cause less than thoughtful buying within overbought conditions lacking supportive underpinnings, including money flow. This is almost always a bad idea. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:14 a.m. Central Time, and I'm recording this in preparation for the market day, April the 24th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see just what happened in our overnight action. In our morning report, we show the four broad market indices are flat on 3 of the 4, with the exception being the NASDAQ, which had some really important companies reporting earnings, which is likely the direct cause of pushing that index up. It is up about 0.6 of 1%. In terms of crude oil, it is down about 0.4%. The euro is scratch. Bonds and gold are both down about 0.27 of a percent. In overseas action, China down about 0.5%, Hong Kong going the other way up about 0.84 of a percent, and then Japan, again the reverse, down 0.83%. Germany up 0.73%, United Kingdom up 0.45%. So really quite a mixed bag. You have U.S. markets, with the exception of the NASDAQ, driven by its earnings events, very, very much at scratch, and then overseas action going in very different directions. So it would seem that not a lot of direction to guide our open, at least from a consensus standpoint. From a macroeconomic report standpoint during the trading day today, there is nothing really of significance on the U.S. market. Once the market opens, before the market, you do have core durable goods orders. In terms of current volatility conditions, obviously with yesterday's up and bullish move, that tends to make things even less volatile. And the short-term VIX down below a 12, 11.84. The regular VIX is also really quite low, as you can well imagine, in the 12.5 range. You have implied IV percentiles. Look at this: 16, 6, 17, 29, all very, very low. And we put in, once again, another day with standard deviation moves across all 4 indices less than 1. You did have a bit more volume come in with yesterday's bullish action, so that was good. However, with the price action intraday, and it did pull back off of those highs, and certainly not as strong a breakthrough as you might like. It's bullish, and certainly as we get into our daily guide, you'll see that our market posture has improved. We've had a number of changes on this today, but it's still, you have to look for that confirmation action. We really want to see volume with the breakaway and a higher close with a ideally the final hour of trading being bullish and finishing on a strong note. That would be very significant, especially going into a weekend, which has a tendency for people to want to exit the market, the short-term traders, and not take positions into the weekend risk. Note that we are looking for this phase 3 opinion to continue with higher highs and higher lows, and we've had a portfolio investor posture change here, a very important change. Uptrend resumes in our IBD status report. Now, a couple things to note about this. Now, we're certainly very gratified to see uptrend resumes and an elevation in the IBD status, but if you look back to all of 2015, we have had this status only hold up for literally a few days. And the first time earlier this year, we had an uptrend resumes and confirmed uptrend that lasted only 3 trading sessions. In another series of event, you had it last for 12 sessions before it broke down. So far this year, having, in quotes, the all clear in the IBD status, uptrend resumes, confirmed uptrend combination, has not been a very durable condition. So as a result of that, you should be looking for confirmation that this has got more legs to it and that we can get some sort of real run. GMI index is a 6 out of 6. Active trader market posture is bullish. Portfolio position sizing opinion, you see the upgrade here, now up to 100%. Active trader market posture also up to 100%, so those are back in agreement. Market timing, we are at extended levels on this most recent move. There's not a lot of intraday edge or bias coming into the day based on candle patterns and the like. 1-day outlook is neutral. 3-day outlook is also neutral. I would color that as neutral to slightly bullish for this 1 and 3 day period. 2-week neutral. Market forecast opinion is overall bullish, but notice also you've got the Dow and the Russell, which are actually bearish. So again, you've got overbought conditions. There's not a lot of pot odds here for any significant follow through from these levels. Unless we get some real energy and momentum that comes into the market, and we just have not seen that kind of energy and confidence really in any of 2015, anytime we have come up to these levels. Now, they say never short a dull market, and certainly we can crawl up and make new highs. But if you look back at the history of similar highs, you often find that there are pullbacks that will wipe out 1, 2, 3, even 4 weeks of these dull market highs. So it is a position which you might want to consider taking reduced position size or scaling in, or taking careful profit management assessments and taking those scale outs as is appropriate. But the other piece to this is that portfolio protection is as cheap as it gets, and buying puts when the VIX is a 12.5 is very inexpensive, and you might want to also consider hedging against a pullback in the current condition. Now, if we continue to get new highs and we start to see volume and real confidence come back into the market, then that may cause you to take a little less of a investment into put protection. But hedge warning status, you've got a change here. It has dropped to a 0 plus, which we defined as normal, with some cautionary aspects. So an important change there, and again, it only represents just one of a handful of days in 2015 which we've had a 0 in our hedge warning status. There are some warning signs still present. The daily squeeze on the VIX, and it's actually trying to fire to the short side, which would infer that you're going to go even lower on the VIX. Obviously, there's not much room for the VIX to fire to the low side. Readings on the VIX below 12 are, while possible for sure, aren't going to go very far, because you're not going to get much below a 10 for sure. If you want to see the probabilities of going below a 10 on the VIX, just look at your option chain and look at what it costs to buy a 10 option strike, and it's usually like a nickel kind of thing. So that just tells you the market makers have no concern about a VIX close at options expiration below a 10. So while this may be technically setting up to squeeze fire to the short side, we're not really taking that as a legitimate signal. What we are really looking for is, when does that VIX daily squeeze fire to the long side and we have an explosion of volatility. Current number of distribution days also remains cautionary. We still have a relatively high count here with NASDAQ at 6, S&P at 5. Other things have changed though. You do have very nice new highs, new lows in the New York Stock Exchange yesterday, 345 new highs. So there was very important participation across a broad number of companies in the New York Stock Exchange, setting up new highs for their month. You do have also, importantly, on the intermarket risk aversion indicators, all 5 of them have now crossed over to the bullish side and are showing a risk on condition. So that is a significant improvement in some of our indicators. Option income strategies, we have taken this to a more normal level. VIX is inside the acceptable window, but in a daily squeeze. That should be something of a cautionary statement for you. Consider the potential for increasing volatility. And of course, if the VIX actually drops below a 12, then that would put the it below the acceptable window for initiation of option income strategies in the typical kind of approach. So also keep an eye on that. But right now, conditions are fine for option income strategies. Just make sure you're biasing your strategy selection for the potential of increasing volatility. Covered call strategies, we're still in a neutral stance, calling for a 2-to-1 distribution between in the money and out of the money strikes. This due to the fact that that money flow and other indicators that are not showing really clear, clean new initiation opportunities. Put selling acceptable for selling puts against the core portfolio basket of stocks that you are willing to own and the position size that you are willing to own it at. In terms of sector specific, obviously a lot of green here, a lot of healing took place across all the sectors. Consumer staples perhaps being the weakest of the sectors from this indication. As a percent change yesterday, look at this, telecommunications up 2.24%, energy, utilities following. So again, consumer staples was the weakest yesterday, down 0.52%. So pretty interesting day here. We'll see what today and Monday bring for us. You do have in our industry groups, retail, internet, healthcare, railroads, biotech in our top 5. So not a lot of change there. Those are the top industry groups to continue to keep your eye on. So I think that should just about wrap it today. Some important trading that's going to take place today into Monday and Tuesday. The seasonality, I should say, for April has been right on course so far. We talked earlier in the month about an expectation of some weakness going into tax day, followed by strength in the back half of the month. And so far, that has been spot on. Let's see how this month wraps up, the final trading days of the month. If you are getting value out of this each morning, we in turn request that you like us on YouTube and share what you have found with your trader friends. That is much appreciated. Additional information about all of our products is available on the website. And you'll also see the email address, support@falconglobaltraders.com. Disclaimers: hit the pause button if you need more time to review that. And then, of course, we greatly appreciate you each and every trading day in the Falcon Global Trading community. We'll look forward to seeing you back here on Monday morning.